Okay, welcome to Accounting 102, Chapter 19. This chapter is focusing on variable costing. What you've learned so far is called absorption costing. What that means is the cost to make a product. We're still manufacturing products here. The cost to make a product includes direct materials, direct labor, and all overhead. And you've learned that from chapter 14 on. So that should be nothing new. That's called absorption costing. We're absorbing all the costs to make the product into the cost of the product, which makes sense. We want to know how much this product really costs to make completely so that we can charge enough to make a profit. Now, we're going to start dividing our overhead into two different categories. Variable overhead are things that vary with the production level. In other words, the more products we make, the more costly this is. Heating and air conditioning, electricity to run the plant. The more we produce, like if we run 24/7, that's going to use a lot of electricity and heating and air. That's called variable overhead. If we're having a bad month and we're only running 8 hours a day, we're not making as much, and we'll use less direct materials, less direct labor, and less electricity and heating and air. Variable overhead. Now, fixed overhead is things that don't change from month to month. No matter if we produce, 100 units or 10,000 units, the fixed overhead is the same every month. That's like the rent on the factory, the supervisor's salary, which is fixed no matter what. These are things that don't change with production. And all that's included in the cost of the product, of course, absorption costing. What we're going to start talking about today is variable costing. And this may seem weird to you, but we're only going to include in the product cost direct materials, direct labor, and the variable overhead only. We are not going to include the fixed overhead, supervisor salary, factory rent, factory depreciation, the things that are the same every month. We are just going to exclude them from the cost of the product. Now you may think, well, that's going to mess up our profit, isn't it? It's going to seem like it costs less to make the product because we're just leaving out the fixed overhead. Well, and you're probably right. Now, we're not leaving out the fixed overhead altogether. We are going to include it on the income statement, but it's going to be down there with all the other expenses of running the business, like the general administrative, the payroll, the accounting, just all the things that don't relate to production. We will still include those down at the bottom of the income statement. And I'll show you an example in just a little bit here. But for now, I just want you to realize that absorption costing is GAAP. We are required to do our financial statements using absorption costing. We are required to include all this in the product cost. However, a lot of managers, they want to see variable costing. They want to focus on, what are the costs I can control? Direct materials, I can minimize these costs, minimize these. We can try to make savings, and they just want to focus on the variable costs. These are kind of set in stone and they don't want to focus on them. So this is just a preference for a lot of managers who may want to see the variable costing income statement with this just separately. But GAAP, for purposes of filing our financial statements with the SEC for publicly traded companies, we've got to include the fixed overhead in the product cost. So here's a little example here. Under absorption costing, we are making some products. I don't know, how about coffee pots? Each coffee pot is $4 of materials, $8 of labor, and we're going to make 60,000 of these things. Variable overhead, we have calculated at $3 per coffee pot. And fixed overhead, just in general, we spend $600,000 a year. Now, under absorption costing, product cost would be calculated as per coffee pot, $4 for materials, $8 per labor, variable overhead $3, which was all given to you. And then fixed overhead, $10 per coffee pot. And that's just simply the total fixed overhead of 600,000 divided by the number of coffee pots, because we're trying to get the per unit cost to make a coffee pot. So under this scenario, we want to charge at least, $25 per coffee pot, or preferably a lot more to make a good, nice profit, right? Under variable costing, we just leave out the fixed cost. So we come up with $15 per coffee pot. All right, seems weird, but I'm telling you, some managers want to see just this. They don't want this in the equation. And in addition, they've given us this additional information. This is not part of making the products at all. This is selling and administrative, nothing to do with manufacturing, but these are still costs of our business. And then in this example, we're going to do 3 years. And I know it may seem tedious to you, but we're going to do 3 years. I'm going to go through an example. In year 1, we actually do make 60,000 units, and we sell every one of them, which leaves us with no ending inventory at the end of year 1. In year 2, we're pretty excited. We make 60,000 more, but we have a kind of a bad year. We only sell 40,000. So we are left with 20,000 at the end of the year, left over, still sitting in ending inventory, not sold. Nevertheless, in year 3, we are pretty confident, and we go ahead and make 60,000, and we sell 80. So everything just kind of works out. No ending inventory at the end of year 3. In year 1, production and sales are equal, as you may remember. And this is what our income statements will look like under both variable and absorption costing. Under absorption costing, and remember, this is the correct income statement. This is what, for financial reporting, for GAAP, for investors, creditors, this is what they want to see. We sold 60,000 units. Guess what we sold them for? $40 a piece. That was given to you right here. The sales price, $40 a piece. So to get the sales, it's like that. And then if you look at the variable costing income statement, I mean, sales are sales, right? We sold that many and we got that much for them. So the sales, that doesn't differ. That's the same under absorption or variable costing. But back to absorption. This follows the formula that we have been using for the past Accounting 101 and 102. Sales minus cost of goods sold equals gross profit. Then we take out the selling and administrative, and that gives us what we call net income, or here they're just calling income. So the gross profit is sales minus cost of goods sold. And I said absorption costing, which means we include fixed overhead. So that's where the $25 comes from, because we include the $10 of fixed overhead. And then we take out our selling and administrative and get to that. Now look, the answer is the same on variable costing. It's just kind of rearranged differently, isn't it? Under variable costing, we take out sales minus the variable expenses. And that's the variable cost of goods sold and the variable selling and administrative. All variable expenses, even the ones that don't relate to production. But that gives us that magic number that you learned about in the last chapter, contribution margin, which is sales minus variable cost. The $15, that is this. And then the variable selling, $2 per unit. Now it costs us $2 per unit that we sell, not produce, but sell. I don't know, this is probably the salesperson's commission. For every unit they sell, we got to pay them $2. Then we take out the fixed expenses, all of them, the fixed overhead and the fixed selling, to get our net income of 580. Just 2 different presentations of the same information. Why do you have to learn both? Because, again, this is required under GAAP. This is what a lot of your managers are going to want to see when you get into your job. In the second year, so I'll refer you back to my timeline, year 2. Remember, we produced 60,000 because we were feeling pretty confident, but it turned out to be not so good of a year because we only sold 40. So in year 2, here is how the income statements will look. There is a difference between absorption costings net income and variable costings net income. Let's explore this and see where we can identify the difference. My sales, again, sales are the same no matter what, because we really sold 40,000. That's no getting around that. And we really got $40 a piece for them. So the sales are the same. Now remember our cost of goods sold. Remember, it doesn't say cost of goods produced. It says cost of goods sold, which gives us gross profit. All right. Then we take out our selling and administrative. That's no different. It's 280 no matter how you slice it. That's the fixed selling. And then the variable selling, remember, is $2. We got to pay each sale person $2. And we sold 40,000 pairs of skates. So that's that, 320. Now let's look at the variable costing income statement. Sales are, of course, the same because we got $40 a piece and we sold 40,000 pairs of skates. But then we take out the variable expenses, all of them. Variable cost of goods sold, 40,000 sold, right? Not produced, sold, times the 15. Variable selling, well, we sold 40,000 and the commission was $2. But why is our net income so much worse? 120 versus 320. Well, let's see. Well, fixed overhead, 600,000, and fixed selling 200. What is the difference? For this fixed overhead, we're using the whole darn 600,000. Where's the fixed overhead over here? $25, right? But only times what? For the fixed overhead, it's only based on the units sold, which is 40,000. But that was if we divided it up, among the units produced. Fixed overhead was $10, but that's only because we divided it by the 60,000 units. See, for the fixed overhead, we're taking the $60,000, right? Dividing it by the number of units produced to get $10, but then only multiplying it back out times the number sold, 40,000. So our fixed overhead is cut way down in this one. Whereas on the variable costing, we're just plopping the whole darn fixed overhead of 600,000 right on here. Yeah. So that's why we took a big hit on this version of the income statement, because the whole 600,000 of overhead is on here. Over here, it's the 600,000, but divided by 60,000 to get 25. But then multiplied back out times only 40,000 because we only sold 40,000. I think it was $4 of materials, $8 of overhead, some variable overhead, and some fixed overhead of $10. That's what's in the 25. Now, let's take the third year. And if you recall, in the third year, production, we produced 60,000 pairs of skates, but we ended up selling more than we produced. We sold 80,000 pairs. How's that possible? Well, because remember, we had 20,000 left over from the last year. We predicted we'd sell 80,000 units. And because we had 20,000 left over from last year, we decided to only produce 60,000. Sales, we sold 80,000 pairs of skates at $40 a piece. That's $3.2 million on both income statements. Cost of goods sold now, folks. $25 per unit. And I think you know where that came from. We've already talked about it a couple of times. Gross profit, then you take out your selling and administrative to get $840. Let's see how it's different on the variable costing. Sales minus variable cost of goods sold, the $15 only, because the fixed of 10 isn't in there. Contribution margin. Then we take out the fixed overhead. Now look at this. In this case, the variable costing income is through the roof, whereas the absorption costing is suffering, only 840 versus 1,040,000. Now, why do you think that is? Why the difference? It's the same reason, isn't it? I want to do a couple of homework problems. So under absorption, just remember that we do want direct materials, direct labor, we do want the variable overhead and the fixed overhead. And you can plug in the numbers, they're right here, okay? As far as a fixed overhead, you just take that number, fixed overhead divided by the units produced. And then they ask you the same thing under variable. I mean, it's just this simple, you know, right? Direct materials, direct labor, and variable overhead only. So just don't put anything here and then add them up and you've got your answer. So those first couple are just really easy. Now, variable costing income statement is just like the slides on those three slides. So here's a variable costing income statement. Here's an absorption costing income statement. And we can quickly blow through a variable costing and an absorption costing income statement if you want. We always start, of course, with sales. And then variable expenses. Less variable expenses. And as all of them, is direct materials, direct labor, variable overhead, all that stuff. Some problems call it variable production costs. So that gives you contribution margin, right? And then we take out our fixed expenses, less fixed expenses. And the fixed ones are, of course, our fixed overhead and our fixed selling and administrative. Yeah. We sold each racket at $90 times, we sold 4,900 of them. So that's 441,000. And then the variable expenses, 49,000, okay, times the variable, these three things, 12 plus 8 plus 5, 12, 8. Okay, so $25 times 4,900. 122,500. Just the variable. Don't include the fixed overhead in there.
So
The
then it
variable
would
selling.
be 2 times 4,900, right?
Yeah, because we sold 4,900. So what's 2 times 4,900? 441. 132, 300. And the fixed overhead is 78,000. Let's type it in. All of it. And then the fixed selling is 65.2. So my net income is the contribution margin minus that 308,700 minus 143. Now, what I do want to do the absorption, because remember, this has that tricky part to it about the cost of goods sold. Again, of course, sales is where we start. In your homework, this will not say static, it'll say algo, which means these will be different numbers than number 3. So just be on the lookout. For y'all, it won't be for the same number in both problems. You'll have to do the math again. Now, sales, this is absorption. So cost of goods sold equals gross profit. Then you take out the selling and administrative to get your net income, or they're calling it income now. So this is the format of the absorption one. Now, cost of goods sold is going to include direct materials, direct labor, variable overhead, and the fixed overhead. Now, to get the fixed overhead, we first divide down by the produced. So the fixed overhead is 78,000. Remember, we're going to divide by produced. So 78,000. 78,000 divided by 6,000 equals $13 even. So I'll take my $13 for the fixed overhead, add it to these other 3 costs, which is 12, 8, 5. I get $38. Then I take the $38. It's $38 times the number we sold. So 4,900 is 38. That's 186,200. That's my cost of goods sold. Then, of course, selling and administrative is the fixed and the variable. So the variable selling and administrative times 2. And we add it to the fixed selling of 65.2. So 9,800, yes, 75,000. That is basically the entire chapter, what I just went over. These are all just variations on the things we've already done. This is from a previous chapter, compute contribution margin ratio. That was on your formula sheet, chapter 18 formulas. So be sure you refer back to this for the unit test, because a lot of the questions on the unit test will be these formulas.